Hey everyone, fintech here. SoFi has become one of the most innovative and high-profile fintech companies in the world over the past few years. They put their name on a stadium that hosted last year's Super Bowl. They continued to roll out new products for their customers, and they even recently attained a national bank charter. But SoFi just announced their acquisition of a new company, Technisys, that is going to add on to their already impressive capabilities and could ultimately change the way SoFi's entire business works. So in this video, we're going to be diving in detail into SoFi's latest merger, looking at what benefits Technisys provides to SoFi, why SoFi paid the equivalent of $1.1 billion in stock for the company, and how the merger plays into the very core of SoFi's future strategic direction. We'll also look at the potential downsides of this acquisition and warning signs we need to watch out for as good investors. Because when you acquire a company with the goal of making it the digital core of your business, you'll want to know the ins and outs of what's going on. So hit the like button if you want, and let's start with the details of the merger. Technisys is a leading cloud-native digital multi-product core banking platform. Now that sounds like just a word salad, so let's make it simple. Essentially, other banks and fintech companies use Technisys as the technological backbone for their own offerings, which is why the company boasts 100 million banking customers across 16 countries, even though they themselves don't make that much money. For the acquisition, SoFi plans to pay with their own stock, offering 84 million shares of SoFi common stock, which as of last week put the value of the acquisition around $1.1 billion in total, or just under 10% of the company's total valuation. Now that value is going to change a little as the stock price moves around, but that 10% number gives us a good ballpark of how big SoFi plans on this deal being. Now, for those of you who follow SoFi closely, this merger may remind you of SoFi's acquisition of the Galileo Technology Platform back in April 2020, where SoFi then paid $1.2 billion to acquire Galileo, again around 10% of the company's market cap at the time. At this rate, SoFi is buying up small banking companies like I buy snacks when I go to the grocery store on an empty stomach. I just can't resist those sour cream and onion lays. But if you're thinking these mergers are similar, your head is in the right place. Because if you follow SoFi's strategy from acquiring Galileo 2 years ago to now buying Technisys, the clues to this latest acquisition have been there all along. So to understand this acquisition as well as SoFi's whole strategy of acquiring companies in the first place, we need to talk a little bit about SoFi's Galileo Technology Platform. So what is their technology platform? That's a super vague name. Well, basically that's the name they give to all the technology which is not tied to any specific product like their investing app or their spending tracker. It's more of a technology service that they provide. And up until this point, 99% of this technology came from their acquisition of Galileo. But that's going to change with their new acquisition. So Galileo is fundamentally a payments processor. They offer APIs or application programming interfaces where just using a relatively simple piece of code, different companies, banks, and startups can use their API to process their payments. Some of the use cases for this are issuing virtual cards or enabling digital banking. And they offer these services to all kinds of companies who want to use their platform, from small, low-cost startups to multi-billion-dollar businesses. Now, Galileo ran as its own business for years before SoFi acquired them. In fact, it's actually an older company than SoFi. From early on, they had a laser focus on the payment space, with category-leading APIs and comprehensive back-office support that made it easy for companies to offer great products to their customers, and let Galileo handle the details around how to process payments for them. Today, there are over 89 million Galileo accounts, bringing in $88 million in net revenue per quarter. Part of what makes Galileo unique, aside from their great APIs, is how well they address all aspects of the payment space. They offer AI-powered fraud detection that results in 80% fewer fraudulent transactions than their competition. In 2020, they launched Galileo Instant as a fast, low-cost way for early-stage companies such as fintech startups, gig economy, e-commerce, and marketplace companies to enable digital payment. And they've already had thousands of companies sign up for that service. Not to mention the success they've seen serving much larger enterprise customers as well. A couple of companies you might have heard of that use the platform are Dave.com, Tomo Credit, and Robinhood. These are like the guys in your company who keep everything running in the background but never get the limelight or really the respect that they deserve. And you only really realize that they exist if they ever disappear. And now that SoFi owns Galileo, they have put them at the center of their plans to become the AWS of fintech, hiring the former vice president of finance at Google Cloud to lead Galileo and their move to the cloud. So Galileo wants to become like AWS, which is the largest cloud provider in the world that runs a good chunk of the internet on top of it. Only SoFi hopes to run the financial services industry on their technology. And now that they have most of their technology infrastructure moved over to the cloud, that sets them up to start acquiring new cloud-native technologies. Enter Technisys. SoFi SoFi's obviously been building their strategy toward providing cloud-based financial services for a while, and Technisys is the leap forward SoFi's been needing to really get into the space in earnest. But let's talk about what Technisys actually does. Technisys offers core banking services in a cloud-native way. So while a traditional bank runs on an ancient machine in some back office somewhere that only processes stuff every night, hence why the 3 to 5 business days it takes to do anything, Technisys operates more like a modern technology company, where other banks can use their services in little modular pieces as needed. And they can scale up as quickly as they need to do as well. Now, up until now, SoFi has had to use a single legacy software provider to power their banking and savings accounts, and yet another service for their credit card transactions. But now, SoFi can take all those transactions in-house, which also goes along with SoFi recently attaining a bank charter and simplifying the legal process of them handling these kinds of transactions in the first place. They showed this progression in a slide on their website. Generation 1 on the left side were these monolithic mainframes that offered no flexibility. These are what are running most of the big banks today. Then in the 2000s, you had lots of software as a service providers offering services, and now you have applications running natively in the cloud with real-time analytics and extremely high flexibility in your use of the product. That's the benefit technologically, but it all comes down to making SoFi more money. They plan to move from their existing vendors to a combination of Technisys and Galileo over the next 2 to 4 years, giving them huge cost savings and, more importantly, flexibility in launching new products and services. Technisys alone is expected to generate around $800 million in revenue through 2025 and save SoFi an additional $85 million. This all ties back to SoFi's Better Together strategy, which is their way of saying they want to vertically integrate the financial services field until they own everything. Customer acquisition with their very public SoFi app, lending, payments with Galileo, banking, budgeting, tax filing, everything you need to run your life financially, SoFi will have a product in the space. But how much of that vision can be attributed to SoFi's existing capabilities, and how much of it ties back to Technisys? Isn't it possible that SoFi could have done all this on their own without dropping 10% of their market cap on this company? Well, let's really look into what SoFi is getting for their money, because the answer to that question is going to define whether or not we even want to invest in SoFi going forward. So first off, could SoFi have built what Technisys has or paid another company to build it for them? Well, yes, I think they probably could have. There's nothing incredibly unique going on here, but it would have cost them something more valuable than money. Time. And then, is this acquisition worth the cost solely in terms of the money Technisys will make? Well, probably not. Technisys has a lot of customers, but the banks they work with get more value from those customers than they do directly. If SoFi let them run as an independent company, they would likely never see a direct return on investment. So why then would someone like SoFi CEO Anthony Noto choose to buy them? Noto has a deep business background as a managing director at Goldman Sachs and as the CFO of the NFL. So clearly he's not dumb. Well, I think we can see exactly SoFi's plan for Technisys just by looking at the name of their latest investor presentation on the acquisition, Project Atom. Technisys will provide the fundamental building blocks on which SoFi will build their new business as the fintech cloud. In the short term, SoFi will continue to focus on gaining new customers, and a mix of sleek marketing, strategic acquisitions, and continued customer focus will help them do that. Plus, with their recent push into markets outside the US, such as Galileo launching in Latin America in 2020, and opening an office in Mexico City and certifying MasterCard's local Mexican domestic switch. Or with Technisys opening them up with 11 new geographic opportunities in South America. They are clearly going to get bigger on the consumer-facing front. But similar to Amazon, at a certain point, most of SoFi's money may not come from their consumer-facing business at all, but rather from providing business services to other companies. When we all think of Amazon, we think of their e-commerce website, or their voice assistant Alexa, or maybe their Prime Video service. But when companies hear Amazon, they think of Amazon Web Services, a cloud service provider that runs much of the world's businesses. AWS makes it possible for companies to launch in literally a day, building their website, their back-end, AI services, all on the platform. And from there, they can expand to a nearly infinite scale at the click of a button. It's why startups can go from 100 users to 100,000 users in a month without their service crashing like they used to. And even though AWS only makes up 13% of Amazon's total revenue, it makes up 100% 100% of their operating income that they continue to use to grow their business. So when SoFi says they want to be the AWS of fintech, they have a very different dream from just being a big bank. They want to vertically integrate the digital fintech space, then start launching new cloud-native services that they can sell to other companies in the finance space. So here's what I predict is going to happen next for the company. First up, acquisitions are not over. Now that SoFi has their cloud backbone in the form of Technisys and Galileo, they're going to start launching new cloud-native services. Some of these may be built in-house by their Galileo team, which has been put in charge of the new Technisys acquisition, while many of these are likely going to come from a slew of smaller companies that SoFi will acquire over the next few years. Expect SoFi to start snapping up small, single-product companies that offer a best-in-class service as a way of growing their competitive advantage in the field, similar to what Amazon commonly does in the cloud space. Over time, they will use their increasing scale, data, and interoperability to launch even more services that other companies can't replicate easily. And from there, they will work to become the go-to place for any business's digital finance needs. And if everything goes to plan from there, they will continue to steal banking customers from legacy financial institutions until all that's left are a few too big to fail legacy banks and a bunch of smaller, more niche fintech companies, at which point they will be considered the de facto fintech company in the world. Or they'll fail to properly integrate with all their acquisitions, and like Yahoo, they'll flounder under the weight of their own sprawl until they lose purpose completely and fade away to become a footnote in history. Either way, it sounds like it'll be an interesting story, and it'll be one that I'm watching and covering on this channel. And next week, I'll be dropping a video on SoFi's latest earnings report covering all of 2021, so make sure you're subscribed for that. Also, grab your free $5 when you sign up for SoFi using the link in the description. Free money, and it helps SoFi grow, so if you're an investor, that's a win-win. Don't forget to like and subscribe, and I'll see you next time.